Hi friends, in the previous session we saw the traditional techniques, that is we have seen the non-discounting techniques. Let us now move to the modern techniques or the discounting techniques. So what are those techniques in which we use the discounting factor to use these tools to make the capital budgeting decisions? We said there are majorly the main techniques are nothing but discounted payback period, NPV, profitability index, IRR, and lastly MIRR. Now let us start learning or revising one by one. That is to start with discounted payback. Discounted payback. Friends, what is payback? Nothing but payback period. That is the period within which the investment is paid back through CFATs, that we understood in the earlier session. Now what is the discounted payback? Arey boss, you will not simply take the CFATs, the cash flows after tax. We will take the discounted cash flows of each year, bringing down to the current year so that we can compare with the current year. Absolutely yes. How do we do that? Let us take a small example. Let us say in a timeline of say 1, 2, 3, 4 years. Let us say the initial investment is 10 lakhs. Then let us say the CFATs are some 2 lakhs, 3 lakhs, 4 lakhs and 5 lakhs. Now how do we see? So had it been normal payback, what we will say, 2 plus 3, 5, 5 plus 4, 9, 9 plus 5, 15. Therefore the payback happened in 1, 2, 3, between third and fourth year, after 3 years. Yes. Now what we are saying, it is not 2 lakhs, 3 lakhs or 4 lakhs. We will bring down them, we will consider the discounted cash flows of those respective years. How do we do that? Let us say some 10% is the discounting rate. So what happens? We will take the interest factor, present value interest factor for each year. Absolutely. How do we do that? 1 by 1.1, that is equal to 0.909 for year 1. Okay, 0.909 is equal to 0.826 for second year, is equal to 0.751 is equal to 0.683. Now for each year, instead of 2, 3, 4 and 5, we will write down the discounted cash flows, that is 2 into 0.909. 0.909, yeah. That is 1.818, we will call it 1.82 approximately. Then similarly 3 into 0.826, that comes to be 2.478, we can call 2.48. Yes. Then 4 into 0.751, that comes to be 3.004, so we can call it 3. Then lastly 5 into 0.683, that comes to be 3.415, 3.42. Now what we are doing is we will add to arrive at the cumulative values of all these. Yes, so 1.82, these are discounted cash flows. Now cumulative discounted cash flows. So this is 1.82 only. Now 1.82 plus 2.48, that is 4.3, plus 3 will be 7.3, yes, plus 3.42 will be 10.72. Now when is this 10 lakhs recovered? Somewhere again between year 3 and year 4. This is year 1, year 2, year 3 and year 4. Again between year 3 and year 4, yes, but so it is 10.72 by the end of the year. By end of year 3, it is 7.3. Therefore, how much is recoverable? 10 minus 7.3, 10 minus 7.3, that is 2.7 is recoverable. In the third year, how much is completely recovered? 10.72 minus 7.3, that is 3.42. So for 3.42, it is taking 1 year. Alright, then how much is recoverable totally? That is 10 minus 7.3, that is 2.7. For 2.7, yeah, 2.7 by 3.42 divided by 3.42, that is 0.789. Simply multiply into 12 to arrive at months, into 12. That is 9.47 or 9.5 months, that is equal to 9.5 months. Therefore, discounted payback will be 3 years, 9.5 months or 9 months, 15 days. So this is how we compute the discounted payback period. Friends, we said in capital budgeting there are few important concepts. Out of all, the first concept what we said, the concepts to be learned is selection or rejection. Therefore, using this technique of capital budgeting, should I select a project or should I reject a project? How will I decide is what we are supposed to learn. We use all these techniques at the end of the day to arrive at that point only. Yes. Now, how do we decide should I select or reject? With the help of discounted payback. We said in terms of payback, we said if the target period is some 5 years, if the discounted payback is 3 years, it is less than the target, then we will choose. If it is 7 years, our target is 5, you are taking 7 years, therefore it reject. In similar lines, how do we decide select or reject a project with the help of discounted payback technique? Similar lines, if the discounted payback period is less than the target period, I repeat, if the discounted payback period is less than the target period, the project can be selected. And if the discounted payback period is more than the target period, then it shall be rejected. So that is one golden rule we are supposed to remember. That is, in short, we will write, if discounted payback is less than, remember, not more than, target period, implies select. If discounted payback is more than the target period, that means it is taking more time than what it is required, implies reject. So this is how we select or reject a project using the technique of discounted payback or discounted payback period. Friends, let us now revise the next technique or tool for capital budgeting, that is NPV or net present value technique. If you remember, we called this as the king of all the techniques. Why? Reason being, NPV is not only the most popular technique, also it is that technique which talks about wealth maximization. With the help of NPV, we can understand which option will maximize the wealth of the company, and hence we consider it as the king of all the techniques. So let us just revise once again as to how to compute this NPV. Net present value or NPV. Now, as the very name says, NPV is the net of present values. Net of present values means present value of cash inflows minus present value of cash outflows. Now, present value of cash inflows is divided into two parts, that is annual cash flows and terminal cash flows, of which we will take the present value. Therefore, we will call it as present value of CFAT plus present value of terminal cash inflow minus present value of cash outflow. Now, these are the present values of cash inflows, be it annual or terminal, and terminal, not or. This is the investment cost. Now, you know how to compute CFAT. We already learnt about from revenues. You also add whatever is saved, and then from you remove the cost, the variable cost, the fixed cost, excluding depreciation and any interest on loan, all these things, and finally we arrive at CFBDT minus depreciation, PBT minus tax, PAT, add back depreciation, we will arrive at CFAT. That part we already know. What is the fate of terminal cash inflow? Now, in terminal cash inflow, apart from the value of the machine, the salvage value of the machine, one more can be the working capital. Working capital we will induce at the beginning of the project, which will be added in our initial cash outflow or present value of cash outflows. Here, the investment cost plus working capital. Any subsidies you have, you will anyways remove that subsidies. Any other further cost you have, subsequent cost, you will bring down to the present value, and hence we call it as present value of cash outflows, not just initial cash outflows. So any cash outflows happening in suppose second year or third year, whatever, you will bring out to the present value, and hence you will categorize under present value of cash outflows. And here present value of CFAT plus present value of terminal cash inflow minus present value of cash outflows will give us what is called our NPV. Now, using this NPV technique, how do we select or reject a project? Friends, we know if NPV is positive, meaning if the PVCI is greater than PVCO, means what? PVCI minus PVCO will be greater than 0. Therefore, if the present value of cash inflows is greater than present value of cash outflows, or if NPV is greater than 0 is positive, then we will say the project is selected. If NPV is negative, the project will be rejected. So this is how, with the help of NPV, we will select or reject a project. Friends, we know that NPV is a wealth indicator. It indicates wealth maximization for any project. Absolutely yes. Now, there's a saying that which says for every coin there are two sides. In the same way, even for NPV, though there are good set of advantages and benefits, there are also few issues or discrepancies concerned with NPV. What are they? Now, people say NPV ignores the initial investment. Did we ignore the initial investment? No. PVCA minus PVCO. No, sir, not in terms of addition or subtraction. In consideration, it ignores. Now, how do we understand this? Let us take a small example. Let us say there are two projects, project A and project B. Let us say the PVCO of project A is 1 lakh. PVC of project B is 1 crore. Then PVCI of project A say is 5 lakhs and PVCO of project say is 1 crore 10 lakhs. Now, if you look at the NPV rule, it says project A ka NPV is 4 lakhs whereas project B ka NPV is 10 lakhs. Therefore, when there are more than one projects, if we say for A and B, when we have to compare, you will say project B is better. No doubt, project B is better in terms of giving a higher wealth. But friends, just understand this factor. When you have an opportunity of investing 1 lakh and you are able to generate cash inflows of 5 lakhs, is it not 5 times the investment? Absolutely yes. Now, what happened in case of project B? You invested 1 crore, that is 100 lakhs, and you are generating only 1 crore 10 lakhs. If you see the numbers, 10 lakhs might look bigger or much higher than 4 lakhs, but financially, if you see with the point of the amount of investment made and the amount of return, how many times it has made, is project A not better? Definitely yes. Sir, how did we arrive at this point? We have arrived with the help of a technique called profitability index. This is how profitability index actually was born. Now, what is profitability index? It talks about the ratio of inflows and outflows. That is, profitability index is equal to PVCI by PVCO. Now, if you look at this, the profitability index of project A is 5 by 1. That is 5 times. This one is 110 by 100. It is only 1.1 times. Now, therefore, with respect to profitability index, what happened? Now you say project A is much better than project B. Now, should we always use profitability index as a measure or tool to decide? No, sir. There are various cases based on which we will have to decide. Now, what are those cases? For that to understand only, we will have to move to the next concept in decisions of capital budgeting, that is selection and decision. In the first case, selection or rejection, simply what we said, if NPV is positive, choose the project. If discount payback period is less than target period, choose the project. With respect to profitability index, we will say, how should we say? We will say, if it is greater than 1, choose the project. Select the project. Less than 1, reject. So, how do you decide this? Very simple. With the help of NPV, what did we say? We said if PVCI is greater than PVCO, then go ahead. Now, divide both sides by PVCO. Can we say PVCI by PVCO, nothing but profitability index, has to be greater than 1. Therefore, in terms of selection or rejection, if PI is greater than 1, you have to select the project. Less than 1, reject the project. Is equal to 1, indifferent. Both inflows and outflows are same. Now, coming into the concept of selection and decisions, that is when you have more than one projects. Boss, what are the projects should I choose? Of all the lot, say for example, I have 5 projects. Should I take up 3 projects or 4 projects or all the 5 or only 2? How do I decide? That we will bifurcate the situation into different scenarios, and then we will decide as to how to make the decision. For that, what we will do is, we will divide the scenarios into 2 types. That is, the projects which are mutually exclusive and the projects which are independent. Now, what is the meaning of mutually exclusive? Mutually exclusive, that means if you select one project, the other has to be rejected by default. Say for example, I have 3 projects. If I am selecting one, the other to be rejected. If I have 4, if I am selecting one, the other 3 will be rejected. Now, see, if in all the 4 projects, even all the 4 may have a positive NPV. But how will we decide? Acha, that project which has got the highest NPV, we will say that has to be selected. Absolutely yes. Similarly, in terms of PI also, the highest PI or lowest discounted payback, we will select based on those techniques. Now, if the projects are mutually exclusive, because NPV is that technique which is a wealth indicator, we will say prefer using NPV. Also with the support of profitability index. So it says, boss, don't ignore profitability index. You also consider profitability index. Just like the example what you have taken earlier, that 1 lakh which could give 5 lakhs versus 1 crore which should give only 1.1 crore. Project A seems to be better with the help of profitability index. Yes. So in general, when projects are mutually exclusive, prefer NPV with the support of PI. Now, friends, in the example what I have given you, see, ideally speaking, to compare, both the inflows are not same, at least not similar. One is 1 lakh, the other is 1 crore. The other option is suppose almost 100 times, not almost, it actually 100 times more than the option A. Therefore, it is not an ideal platform to actually compare. But otherwise, in general, when the cash outflows or investments are similar, we will decide based on NPV with the support of PI. Now, in case of independent projects, what is the meaning of independent? Opposite of mutually exclusive. Meaning what? If you select one, it doesn't mean you have to reject the other. You select all those which you feel are considerable. I repeat. Now, in a simple language, we can say mutually exclusive means choosing the best of the lot. In the lot of 4 or 5, you choose the best. The technique, whatever you follow, is your choice as per the company. NPV or PI or IRR or discounted payback or whatever. If you choose only one, that is, choose the best of the lot. In case of independent, you will not choose the best of the lot, you will choose the best lot. Meaning, suppose there are 5, you may pick up 3 projects, or you may pick up 4 projects, or you may pick up 2 projects. So, what is the best lot? Say A, B, C, D, E, you may choose A and D, or A, B and D, or C, E and D. Like this, you can find out the best lot. Now, how do we choose the best lot? Again, for this independent have been divided into 2 types. When there is no capital limit or capital rationing. When there is capital limit. Again, when there is no capital rationing, it says, boss, again go with NPV, again wealth maximizer, the indicator of wealth maximization. Now, when there is a capital limit, again there are 2 types. Boss, are they divisible or indivisible? Now, if they are indivisible, again go with NPV. If they are divisible, now what is the meaning of divisible and indivisible? Say for example, I have 50 lakhs as my budget, as my fund what is available. Now, there are projects which are costing some 10 lakhs, 20 lakhs, 30 lakhs and 40 lakhs. Now, 10, 20, 30, 40, 10 plus 20 is 30, 30 plus 30 is 60, 60 plus 40 is 1 crore. Now, say for example, I have chosen project A and B, 30 lakhs is exhausted. Now, if project C or D are such, only part of the project can be taken up, then we will call they are divisible project. Means out of 30 lakhs, total fund is 50 lakhs, out of which 10 and 20, 30 lakhs are used. Now, we are left with only 20. If you want to choose project C, only 20 out of 30 lakhs can be invested. That means 2/3 can be done. Similarly, if you want to take the project D, which has 40 lakhs investment, 20 out of 40, that is only 50% of the project can be done. If it can be done in such a way, then they are called as divisible project. Now, if you say, boss, no, if you want to do C or D, you have to put the full investment, then they are called indivisible projects. In such case, in indivisible case, we will again use NPV. If the projects are divisible, we will take the help of PI rankings. Meaning, you will write down the profitability index of all the projects. No doubt NPV you have to consider. But in case of independent projects where there is a capital limit and when the projects are divisible, the most optimistic way of choosing the lot is to rank the projects on the basis of profitability index and then choose those projects and consider them as the best lot. So, this is how we will choose, we will select and decide projects which are mutually exclusive and independent with the help of NPV and profitability index. Friends, before we move to the next technique, let us understand one very important point here. With respect to selection or rejection, that is, should I take or not take, should I choose or not choose, whatever the decision is given by NPV will be the same as per profitability index also. Why, sir? If NPV is positive means PA will be greater than 1. That's what we understood. Therefore, with respect to selection or rejection, should I select or reject, the decision with respect to NPV and PI will be the same. But when it comes to the concept of the decision making with respect to selection and decision, that is to choose more than one projects, in such cases there can be a conflict between NPV and profitability index. That's what we have understood. Now in such cases, we have understood with the help of the chart as to how do we decide which method should we adopt for. Now why is this discrepancy coming in between these two? This conflict is mainly coming because of the initial cash outflows or size of the investment. So this is about NPV versus profitability index. Friends, let's now revise the next technique, again a very important technique, that is our IRR, that is internal rate of return. Internal rate of return, that is IRR. Friends, the internal rate of return on what? The internal rate of return on investment. Whenever we say return, it is usually on investment only. It is not mentioned, not necessary, but conceptually it is the return on investment. Now it is not simply return, it is the internal rate of return. Now, how do we understand? Let us say the initial investment is 10 lakhs, year 0. Now year 1, year 2, year 3, year 4. Let's say it's like 2 lakhs, 3 lakhs, 4 lakhs and 5 lakhs are the cash inflow, CFATs. Now, earlier what we have done to compute NPV, we said we will discount all these cash flows to present value. We will discount all these cash flows to present value and then find out what is the present value of cash inflows. Alright. Now, IRR says, boss, don't discount them. IRR says, it is that rate, the same 10 lakhs we'll put here. It is that rate at which 10 lakhs has generated inflows of 2 lakhs, 3 lakhs, 4 lakhs and 5 lakhs respectively in those year 1, year 2, year 3 and year 4. Now what does this mean? Boss, there is investment of 10 lakhs which is made? Yes. If you have invested 10 lakhs and if you have generated 2 lakhs CFAT in year 1, 3 lakhs in year 2, 4 lakhs and 5 lakhs in year 3 and year 4 respectively, what is the rate at which these returns have been generated? Is called our IRR. Now mathematically it says how to compute IRR. IRR is that rate of discounting at which PVCI is equal to PVCO or PVCI PVCO is equal to PVCI. I mean, so by discounting at what rate? By discounting at what rate will our PVCI be equal to PVCO? So by discounting at, say for example, if I am discounting at 10%, say then what happens if I am having an NPV higher than greater than 0? That means if PVC is greater than PVCO, that is a discount rate. That's a cost of capital maybe. But if I am discounting at say 12%, my PVCI is equal to PVCO, is getting equal to PVCO. Means what? If you are discounting at 12% and if both are same, in the other line and from the other side of the coin, if you see, can we say, acha, by investing 10 lakhs, if I am generating these cash flows, I am generating at a rate of say some 12%. Yes. So the rate at which the returns have been generated on the investment is called our IRR. This is the conceptual meaning, but mathematically how do you understand? The discount rate, the rate at which when the cash inflows are discounted so that PVCA will be equal to PVCO, that rate at which PVCA is equal to PVCO is called IRR mathematically. Now how do we compute this IRR? Now we said there is a technique what we follow. What we do, we will take the help of two discounting rates. Say for example, randomly we will take at 10%. At 10%, say if we get NPV is greater than 0, which we got some say for example we got some 5,000. Okay, so NPV is positive now. Now what we will do, because NPV is positive, we will try increasing the discount rate so that NPV becomes negative. Even if it doesn't become also no problem, but generally we will try at a slightly higher rate, say 12%. Say my NPV became minus 1,000. Let's assume. Now, we will take the help of a timeline, kind of a timeline. So, if NPV is 0 here, if NPV 5000 here, NPV is minus 1000 here. Now, at what rate? At 10%, NPV is positive. At 12%, NPV is negative. So, how we will do is, now we will say, acha, so for a distance of, what is the distance? This is minus 1000 to 0 is 1000 plus 5000. So, this is 6000. So, for a distance of 6000, for a change of 6000 in NPV, the change in the discount rate is 2%. Then, considering this 1000, then for a change of 1000, what will be the change in discount rate? So, 1000 into 2 by 6000. So, can we say 1 by 3? Yes, 1 by 3 is nothing but 0.33. The change is 0.33, friends. From where? We have taken from this side, from 12%. Now, it is between 10 and 12. So, can we say, to arrive at this point, the change has to be 0.33 from where? From 12. Should we reduce or add? It is 12 to 10, it is decreasing. Therefore, 12 minus 0.33, that is 11.67% is considered as IRR. So, this is how we will compute IRR. And now, based on IRR, how do we select or reject a project? Very simple. Sir, if IRR, if the return is greater than the cost, what is cost? The cost of capital. Acha, the cost, say, if the return says 15%, as cost is some 12%, the return, the IRR is greater than the cost, then select the project. If IRR comes to be less than KO, boss, reject the project. So, this is how we compute IRR and select or reject a project based on IRR. Friends, let us now move to the next concept to be learned in the decisions of capital budgeting, that is comparison and decision. Now, what is the meaning of comparison? Very simple. You have two projects, you compare project A and B or X and Y or D and E, whatever, whichever exhibits a higher result in terms of the technique. For example, as per NPV, whichever project has got higher NPV, choose that project. Whichever has got higher PI, choose that project. Whichever has got lower discounted payback, choose that project. Whichever has got higher IRR, choose that project. All fine. So, this is how we do, and we also said in the beginning also itself that to understand all these concepts, we have to solve the problems. So, when you solve the problems or when you go back and recheck or revise those problems, you will understand one special point here. What is that? Sir, when we are comparing projects, say A and B, at times what happens is, generally for one project, if NPV is positive, PA will be greater than 1, no doubt. If NPV is positive, IRR will be greater than KO, no doubt. But when we are comparing projects, as per one technique, as per NPV, project A may exhibit a higher result, but as per IRR, project B may exhibit a higher result. Then what should we choose? Now comes the conflict between NPV versus IRR. Now, why should this happen? If you said if NPV is greater than 1, NPV is greater than 0, then IRR will be greater than KO, correct, no doubt. But when we are comparing two projects, there is a possibility that there can be a conflict between NPV and IRR. That is called our NPV versus IRR conflict or concept. Now, first of all, why does this happen? Friends, if you have gone through those problems, you will recap all the points what we have said, but in a nutshell, we will just brief down what are the main reasons. This happens because of size disparity, that is disparity of the initial investment. That we also said in terms of NPV and PI. Yes. So, size or to add pattern of cash flows. Now, what is this pattern of cash flows? Say for example, for project A, the amounts recovered in the initial say are lesser. Say it is recovered like 2 lakhs, 3 lakhs, 4 lakhs, 5 lakhs, how we said in the earlier example. Then the IRR may be lesser. For project B, if the cash flows are the other way around, say 5 lakhs, 4 lakhs, 3 lakhs, 2 lakhs, that is reducing, means what? The discount rate at which the bigger number in the initial year to become equal to the present value of cash outflow will be higher. Therefore, IRR of project B may be higher, whereas that of project A will be lesser. So, therefore, the size or that is, and we can say size and pattern of cash flows is 1. Then life of projects. Depending upon the life of projects also, there can be a disparity. This is also possible. Next, therefore, because of these two reasons majorly, that is size, pattern and life of projects, there can be a disparity or in difference in the decision to be taken with respect to NPV versus IRR. Now friends, to understand it mathematically, let us take a small example, say project A and project B, where say NPV of project A is some 10 lakhs, whereas NPV of project B is say some 6 lakhs. Now the IRR of project A is some 20%, say the IRR of project B would be some 25%. Now this is a situation where NPV says project A is better, IRR says project B is better. In such case, now which one do you think is a better technique? The concept says, boss, go with NPV. Now why should we go with NPV? Now why is the scenario happening? First of all, why is this happening? How do we understand this? Say for example friends, let us plot a graph, one with the discount rate on x-axis and NPV on y-axis. Now see, the graph will look like this. So this is project A, this is project B. Now why is this happening? Because see friends, in both the cases PV is positive and that means and IRR will be so and so, means definitely KO should have been less than these two. Say KO is some 15% or 12%. Now if we go on increasing the discount rate, what happens? NPV will decrease. That is what has happened in terms of project A. See, the project A's NPV showing higher in the initial cases but lower later on. Why being? Because as the cost of capital or the discount rate is increasing, the NPV will obviously decrease. Therefore, at some given say some 12% or something as per the question, NPV of project A is higher. But if you go on increasing, so say some 15% or 18%, what happens? The NPV of project A decreases. Now IRR will remain constant for any cost of capital, no doubt, because IRR is just one number, but NPV is not like that. As you increase the discount rate, the NPV will decrease, and this is why there will be a disparity. Now why are we saying that? Why should we go with NPV only? Why not IRR? Because IRR has got a few issues or discrepancies, concerns with it. What are they? IRR assumes a reinvestment rate assumption every time. Meaning what? We said what is IRR? It is nothing but rate at which returns are earned. How are they earned? By compounding. What happens in compounding? You are taking the whole amount and trying to reinvest. That's what is happening in compounding. 100 becomes 110, 110 becomes 121 or 121 becomes 133. So the entire amount is assumed to be reinvested, but it is practically not possible in a business. That is one reason. And at times there can be multiple IRRs also. Therefore, and also NPV is, again coming back to our concept, the basics, is a wealth indicator. That is why people say, or the concept says, boss, when there is a conflict between NPV and IRR, prefer NPV over IRR. So this is about the NPV versus IRR conflict. Now in NPV, the issue with regards to the life of the projects is further addressed with the name of a concept called EAB, that is equalized annual benefit. That is, when you compute NPV for two projects which have different lives, you don't compare the NPVs. When the lives are different, whatever is the NPV divided by the annuity factor of that project. Say for example, project A has got a life of 4 years. Its NPV is some 5,600. Project B has got a life of 6 years. Its NPV is some 6,400. Now simply don't say project B is better. To arrive at EAB for project A, what you'll do, 5,600 divided by the present value annuity factor of whatever is the cost of capital for 4 years. Similarly, versus for B, that 6,400 NPV, whatever we got it, divided by the present value annuity factor of the cost of capital for 6 years. Now you compare, and whichever exhibits a higher EAB, that project is considered to be a better project. So this is the issue addressed with respect to the lives of the projects. In similar lines, if only the data of the cost is given, that is the initial cash outflow is given, and if the expenditures of each years are given, then we will compute the equated annual cost instead of equated annual benefit. We will compute the equated annual cost for these two projects for the respective years, and then we will compute whichever is lesser, the option whichever is lesser, whichever EAC is lesser, we will see that is better. So this is about our NPV adjustments. Now what about the adjustment to be made for IRR? We said there is a problem with reassumption rate. Now to rectify this, another concept came into picture, that is called MIRR, that is modified IRR. Now what is this MIRR? As per the name says, there is a modification made to IRR. What is made by modification? A small change. What is that change? Earlier, we said we are bringing down all these cash flows, 1, 2, 3, 4, 5, whatever, to the present, wherein there is a reinvestment rate assumption assumed. Now, where there is a reinvestment rate assumed, to avoid this problem, this concept says, boss, don't bring it to today. You take all those cash flows to the last year, including the last year's cash flow. Now you will get some value. How will you do this? With the help of future value computations. Now, whatever is the value we have, the future value of all these cash flows, that you bring it to today, and the rate at which the future value is equated to the present value of cash outflows is called our MIRR. Now, earlier what we said, from here we brought here. He said, no, don't do that, ignore that, because there is this problem of reinvestment rate assumption. To avoid that, this concept has come into picture. That is, you take all the values to the future value, the last year ka future value, and then to that future value, what is that rate at which the future value of cash flows is equal to the present value of cash outflow. The rate at which the future value of cash flows is equal to the present value of cash outflow is called as our MIRR. So this is our last concept in terms of the techniques of capital budgeting. Friends, the last concept to be learned in decisions in capital budgeting is replacement decision. This is more or less like our NPV only, but instead of NPV, what we will compute is incremental NPV. Now, what is replacement? You have an existing machine or you have an existing project, you want to replace it with a new machine or a new project. Now, when will we replace it? Instead of comparing to NPVs, here what we will do is, we will write the NPV of the new one first, and from that we will reduce the NPV of the existing one. This also can be done in how? In the way of computation of incremental NPV. Now that is the steps what we use for NPV, that is, instead of initial cash outflow, we will compute net initial cash outflow. That is, whatever is the new machine, when we get it, we will sell off the old machine. There is a tax implication, that net initial cash outflow will compute. CF8 is also net incremental CF8 we will compute. Terminal cash inflows also net incremental terminal cash inflows will compute. We will take all these numbers, the incremental CF80 plus incremental terminal cash inflow minus net initial cash outflow, we will arrive at the incremental NPV. Now, as we said, friends, here the concept will be better understood only when we solve the problems. Now here one special point what we are supposed to put in mind is about the tax implication. Whenever there is one existing project, for NPV we simply used initial cash outflow, or we have reduced, added working capital, reduced salvage value like this. But when there is a replacement aspect, there will be a tax implication. Now that is at the time of year 0 initial cash outflow, there may also be a tax implication at the time of the terminal cash inflow. Therefore, these tax implications have to be considered, and accordingly the computations have to be made. As we said one last time, all these concepts, be it NPV, IRR, profitability index, incremental NPV, there is replacement decision, whatever it is, all these can be understood better only when we solve the problem. So this is about our concepts in capital budgeting.